For this session, we will talk about the taxation of other items of your gross income. So, if you still remember, we said we look into your gross income, and based from your gross income, we look into the taxability of those items. And some items of your income, we have a deduction, some don't have. So we are already done with the major items of your gross income, such as the taxation of your business or professional income. Aside from your taxation of business or professional income, we also talk about the taxation of your gains and billings. We also talk about the taxation of your compensation. And lastly, we talk about your passive income taxation. And based on these different items, we already learned what item is subject to final tax and what item is subject to regular income tax. Now, we look into your other items of gross income. So those are the major items. And now we look into the other items. So what are the topics for this particular session? First, we look into the different inclusions on gross income. So we will now lay down the different items of gross income. After that, we look into the taxation of your other items of gross income. And lastly, we will discuss your partnership taxation. So let's now look into your inclusions on gross income. So the following are your inclusions on gross income. First, you have your compensation income. And we're done with your compensation income. We already know how to tax your compensation income, whether to tax it at final tax subject to a fringe benefit tax or subject to your regular income tax. Next, we also talk about your gross income derived from the conduct of trade or business or the exercise of profession. You know this one as your business or professional income. So in your business or professional income, we also talk for your business or professional income subject to final tax and business or professional income subject to regular income tax. If subject to final tax, it is subject to 8% gross income tax. If RIT, then subject to your tax table. Also, we discussed about your gains and billings from property. So you already know the items subject to final tax, the CGT. And there are only two items subject to CGT. That is your sale of real property considered as a capital asset, and lastly, your stock directly to buyer. All other dealings is subject to RIT. We also talk about interest already as part of your passive income taxation, royalties as part of passive income taxation, dividends as part of passive income taxation, prizes and winnings as part of your passive income taxation, pensions, we have already discussed that as part of compensation. We know when it is exempt and we know when it is taxable. Therefore, there are only three other items of gross income which we did not yet discuss. And what are those three items? The first one is your rent, the second one is your annuity, and next is your partner's distributive share. So as we go through our discussion this afternoon, we will learn the taxation of your rent, your annuity, and your partner's distributive share. And they are your other items of gross income. So let's look into your rent. Let's look into your rent. So what composes your rental income? So your rental income is composed of the following items. First, your collections. Then we have your advanced rentals. Then your obligations assumed by the lessee and your leasehold improvements. Let's look first into your collections. Your collections is your total collections. So when we say total collection, that includes your gross receipts or your collections of rent, whether earned or unearned. Whether earned or unearned. So It is your total collections of rent, whether earned or unearned. So what do we mean by total collection of rent, whether earned or unearned? So it means whether you have used already that rent, it will be considered as a collection. Whether you have used already that rent, you consider it as a collection. So for example, you paid 3 months rent. You paid 3 months rent, May, June, July. Okay, May, June, July. So for sure, you have already used May and you are now using June. So May and June are already considered earned. So again, you have collected 3 months of rent, May, June, and July. Since you have already used May and June, they are considered earned. July, it is not yet used. Therefore, this is considered unearned. So either earned or unearned, they are considered part of our rental income. So whether earned or unearned, they are part of rental income as collections. Furthermore, your advanced rentals will be included. That is your unearned. Okay? Advanced rentals is your uh, unearned. That's why it's still included. If ever it is already included in collections, do not already add advanced rentals. What I want you to learn in your advanced rental is your security deposit. Security deposit. Your security deposit, as a rule, although it is considered as an advanced rental, it is not considered income. It is not considered as an income. It will be treated as a liability. Again, you will not add advanced rental as a security deposit. So for example, you receive a security deposit, you do not include that as an income. Why? Because it will be considered as a liability for taxation purposes. Again, for collections, regardless whether it is earned or unearned, it will be included as part of our rental income. Next, obligations assumed by the lessee. So what is this obligation assumed by the lessee? When we say obligation assumed by the lessee, this is a transfer of liability from the lessor to the lessee. Okay? It is a transfer of liability from the lessor to the lessee. So since there is a transfer of liability from the lessor to the lessee, the amount you have transferred as a liability is considered as an income. So any obligation that is assumed or transferred to the lessee is considered as rental income. And lastly, leasehold improvement. What is a leasehold improvement? A leasehold improvement is any improvement made on the lease asset. So for example, you have leased a building. You have leased a building, and the building has 4 floors. Now you improve that building, you added another floor. You added another floor. The additional floor is considered as a leasehold improvement. It is considered as leasehold improvement. Now, how do we account for your leasehold improvement? You account for it in 2 ways. So we can tax it in 2 ways. The 2 ways to tax it is either outright method or your spread out method. So there are 2 ways to tax the leasehold improvement: outright method or spread out method. So in outright method, the leasehold improvement will be included as income as a whole. Okay? The leasehold improvement will be considered as income as a whole. However, if that is as to depreciation, you include depreciation on the lease term based on the life of the leasehold improvement. So it is an income as a whole, and you include a depreciation based on the lease term using the life of the leasehold improvement. Okay, so let's say, for example, the amount of improvement is 1.2 million. The amount of improvement is 1.2 million. The lease term is 3 years. And the life of leasehold improvement is 6 years. The life of leasehold improvement is 6 years. So based on outright method, so year one, year two, year three, that is the lease term. Then we can include as income, as leasehold improvement, the total amount, 1.2 million. At the time, you have completed it. So it is income as a whole, 1.2 million. And you can depreciate it over the lease term using the life of the leasehold improvement. So 1.2 million divided by 6. So 200,000 per year. So that's how you treat it using an outright method. But how about an spread out method? In your spread out method, the leasehold improvement, you will only get the book value at the end as income. And for depreciation, no depreciation. Okay? You get the book value at the end as income, and as to depreciation, no depreciation. So, sir, how do we get for the book value at the end? So, you get the cost of the leasehold improvement less the depreciation over the life, then that is the book value on the end. So, that book value at the end will be treated as income and will be spread out over the list term. Okay, so let's have the same facts. So the cost of the leasehold improvement is 1.2 million, less the depreciation over the lease term. So the lease term is 3 years, and the life of the leasehold improvement is 6 years, times 1.2 million. So we have here 600,000 total depreciation. So the amount of our book value at the end is 600,000. Now, the 600,000 will be spread out over the lease term. So year one, year two, year three, leasehold improvement. So we divide that over the lease term of 3 years. So 200,000 per year one, year two, and year three. And as to the depreciation, take note, no depreciation will be recorded. So this will be zero each, zero each. So again, the difference between an outright method and your spread out method, as to leasehold improvement, the total amount will be considered as an income under outright. However, under spread out, only the book value at the end will be considered as an income. Next, as to your depreciation, there will be a depreciation over the lease term using the life of the leasehold improvement. While under your spread out, there is no depreciation to be recorded. Okay? So let's have an example. So Naruto leases its lot to Sasuke for a term of 3 years with an annual rental of 50,000 pesos. As of January of the first year, Sasuke completed the construction of an improvement on the lot with a value of 1.5 million with an estimated life of 5 years. The leasehold contract stipulates that the improvement will belong to Naruto after the term of the lease. So 3 years is the lease term. So the lease term is 3 years. The leasehold improvement life is 5 years. And the leasehold improvement is 1.5 million. Okay. So compute for the annual rental income for 3 years using spread out method and outright method. Okay. So let's start first with spread out method. So under spread out method, we need to get for the book value. So we need to get the cost of the leasehold improvement less the depreciation over the lease term. Then we have the book value. Okay. So what is the cost of our leasehold improvement? It is 1.5 million. So for depreciation over the lease term. So the lease term is 3 years. So lease term over the life. The lease term is 3 years. The life is 5 years. You multiply it to the cost of 1.5 million. So we have here 3 over 5 multiplied by 1.5 million. So we have 900,000. So the book value will be 600,000. And this 600,000 will be spread out in the lease term. So there are 3 years. So 600,000 divided by 3 because our lease term is 3 years. So we spread it out for 3 years, 200,000 per year. Now, as to depreciation, what did we say? For depreciation, there will be no depreciation. So furthermore, there is an annual rent of 50,000. So we have here collections of 50,000 each year. So the total rental income will be 250, 250, and 250. So that is for spread out. Next, for outright method. So under outright method, what we do is we get for the value of our leasehold improvement as a whole. So we have here your collection. Annual is 50,000, right? Okay. And then we add as a whole the value of our leasehold improvement on the year you have completed the leasehold improvement. So what is our rental income? This is 1,550,000, 50,000, and 50,000. And you can deduct your depreciation and you can divide the leasehold improvement over the life. So this is 300,000, 300,000, 300,000. So our net taxable income will be 1,550 less 300 is 1,250,000. So this is negative 250, negative 250. Okay. So if the question is what is the rental income, your answer are the following: 1,550,000 in year one, 50,000 in year two, 50,000 in year three. As the net taxable income, 1,250,000 for year one, year two 250 negative, year three negative 250. But take note, whether or not it is spread out or outright, you will yield the same amount. So 250 plus 250 plus 250, this is 750. 250 less 250 less 250, that is still 750,000. So regardless of method, you have the same amount of net taxable income. However, the difference lies as to the recognition of the leasehold improvement. In spread out, you spread out the book value at the end using the lease term. In outright, you recognize outright the amount of the leasehold improvement. There is no depreciation in spread out. There is depreciation in your outright method. Next, we have your annuities. So what is an annuity? An annuity is an installment payment received for life insurance sold by insurance companies. So normally, you give premiums to your life insurance companies, and after some time, there will be a payout. This payout is the annuity. This payout is the annuity. An annuity is composed of two items. Normally, annuity is composed of two items: the premium itself, including interest. The premium itself, including the interest. So an annuity is a contract with insurance that promises the owner to be paid a regular income payment. The regular income payment is known as annuity. And what is the composition of your annuity? A premium and an interest. A premium is considered exempt. Why? Because there is no taxable income here. Why? A premium is only a return of capital. It is merely a return of capital. Remember, if it's only a return of capital, it is considered non-taxable. So a premium, when it is part of the annuity, it is exempt. It is considered non-taxable. While the interest is considered the income on the insurance premium, the interest is considered as the income on the insurance premium. This is treated as a return of capital. This is treated as return of capital. Therefore, only the interest portion of annuity is taxable. Only the interest portion of annuity is taxable. So why? Because the interest portion is the return on capital. The interest portion is the return on capital. So for example, your total annuity is 18,853. 10,000 is for premium. The amount taxable is the difference between the total annuity less the premium. So 8,853, this pertains to our interest. This pertains to our interest. So in short, annuity less the premium, this is the amount taxable. Or in short, the interest is the amount taxable. Okay, so annuity less the premium is the amount taxable. In short, the interest is taxable. Okay, so we're done with two items already, rental income and annuity. Next, we go to the last item of gross income, and that is your partner's distributive share. So what is your partner's distributive share? Partner's distributive share is the share of the partner in the partnership profit. So there is a partnership profit, and this partnership profit will now be distributed to the partners. Okay, your partnership profit will now be distributed to the partners, and the distribution to the partners will be subject to taxation. Okay, the subject of taxation depends whether the partnership is a general professional partnership or a general partnership in trade or general co-partnership. A general professional partnership is a partnership created for the exercise of a common profession. While in your general partnership and trade or general co-partnership, this is known as your business partnership. This is known as your business partnership. Okay, so the taxation of your distributive share differs depending whether it is a general professional partnership or a business partnership. So let's look for the taxation if ever it is a general professional partnership. So general professional partnership, uh, the partnership is not subject to income taxation. It is exempt. While the partner share is added to gross income and it is subject to a creditable withholding tax. 10% if the share is less than or equal to 720. 15% if the share is greater than 720. So in short, this is the partnership income less tax. The tax will be zero. Sir, why is the tax zero? Because it is exempt. So this is your income after tax. Okay. So the income after tax will now be distributed to the partners. The income after tax will be distributed to the partners. Okay. Let's say, for example, the partnership income is 1.5 million. The partnership income is 1.5 million. And Naruto is one of the partners sharing 70%. And Sasuke is one of the partners sharing 30%. Okay, so how do we share that? So we have here your partnership income of 1.5 million. You deduct the tax, which is zero because it is exempt. So your income after tax will be equal to 1.5 million. And now you distribute it to the partners. We have here Naruto and we have here Sasuke. So 70% for Naruto, 30% for Sasuke. So we get the values of this sharing 1,500,000 multiplied by 70% will give us 1,050,000. For Sasuke, 450,000. So this is the distributive share. And it will be subject to a creditable withholding tax. If the distributive share is less than or equal to 720,000, 10%, that's why the 450,000 is subject to 10% creditable withholding tax equal to 45,000. And then we also have more than 720,000 subject to 15% creditable withholding tax. Therefore, the share of Naruto, since that is more than 720,000, it is subject to 15% creditable withholding tax. This will give us 157,500. So the net amount shared by Naruto is 892,500, and the net given to Sasuke is equal to 405,000. So take note, the partnership is exempt to tax, and the partner share is subject to a creditable withholding tax. Now, how about if that is a business partnership? If that is a business partnership, the partnership is subject to income taxation like a corporation at 25%. So if this is the partnership income, if this is the partnership income, you deduct a tax at 25%. Then we have your income after tax. Then this income after tax will be distributed. So how do we tax for your distributive share? So the distributive share is net of income tax. It is subject to a final tax of 10%. Okay. So why is it final tax? Because the share is treated as a dividend. So take note whether it is actually received or constructively received, meaning whether the share was really given or distributed or not, you still have a 10% final tax. Take note, the term here is final tax. Therefore, do not include it to the gross income. Do not include it to the gross income. Okay, let's have an example. So the partnership income is 1.5 million. Naruto shares 70%. Sasuke shares 30%. So assuming they are a business partnership, how do we share that? So we get first the partnership income of 1.5 million. You deduct the tax, which is 25%. So 1.5 million multiplied by 25% is 375,000. And the income after tax is 1,125,000. And you will now share it or distribute it to the partners, Naruto and Sasuke. 70% for Naruto, 30% for Sasuke. So the 70% will yield to 787,500. And that is subject to a final tax of 10%, 10%. So this is 78,750. So the net amount given will be 708,750. How about for Sasuke? How about for Sasuke? So Sasuke will receive 337,500 distributive share. That is 30% of 1125. And subject to 10% final tax, that is 33,750. So the net is 303,750. 303,750. So take note, it is subject to a final tax, and now there is a tax rate. Why? Why is there a tax rate, sir? Because you have now a tax here, and this one is subject to final tax. Compared a while back, we have no tax, that's why it is zero, and it is subject to a creditable withholding tax. Okay, so look into their difference. So to see their difference as a whole, let's take this example. Naruto and Sasuke are partners in Konoha. Konoha earned an income before tax of 1.2. The partner share is 70 and 30. Naruto has a separate income of 400 and Sasuke has a separate income of 650. Okay? So let's try to answer it if ever we have a general professional partnership. and a business partnership. Okay. So in a general professional partnership, take note the income first. So partnership income amounting to 1.2 million. We deduct the tax. Since that is general professional partnership, there is no tax. The income after tax is 1.2 million. And it will be shared to Naruto and Sasuke. So for Naruto, 70%. For Sasuke, at 30%. For Naruto, 70. And for Sasuke, 30%. So the 70% of 1.2 million is equal to 840,000. So that is the distributive share. For Sasuke, the 30% is equal to 360,000. And it is subject to a creditable withholding tax. So since this is more than 720, 15%, if less than 720, 10%. So this will give us 36,000 for Sasuke. And for Naruto, it will give us an amount equal to 126,000. Okay. So after that, take note, since this is only a creditable withholding tax, the distributive share will be part of gross income. So in the separate income of Naruto and Sasuke, so we have here your other income of 400 for Naruto, and Sasuke has 650. So Naruto has a separate income of 400. Sasuke has a separate income of 650. You add there the distributive share, which is 840 and 360. This will give us 1,240,000 and 1,010,000. Okay. Next, what if that is a business partnership? So if that is a business partnership, we get the partnership income, 1.2 million, less tax of 25%. So 1.2 million multiplied by 25% is 300,000. So our income after tax is 900,000. And this will be shared by Naruto and by Sasuke. Naruto will share 70%. So that is 630. Well, Sasuke will share 30%. So that is 270. And that is the distributive share. It is subject to final tax of both 10%. So 63,000 and 27,000. Since it is final tax, it is not part of gross income. So it's not part of gross income. So if we plot it, we have here Naruto and we have here Sasuke, or other income plus distributive share. We place the other income of 400 and 650. Then the distributive share will be zero. Why? Why is it zero? Because it is not part of gross income. Why do we have included here? Because it is part of gross income. So take note, a distributive share of GPP is part of gross income, while the distributive share of a business partnership is not part of gross income. So how much is the taxable income of Naruto and Sasuke if that is a business partnership? Naruto, 400, Sasuke, 650. So by this, of course, with this example, you can now see the difference between a general professional partnership and a business partnership as to their taxation. And that's it for the other items of gross income. So let's wrap up whatever we have learned this afternoon. So other items of gross income. So we have only three other items. We have your rental income. We also have your annuities. And we have your partner's distributive share. Okay. For rental income, it is composed of your collections plus advanced rentals. Aside from your advanced rentals, we need to add any obligation assumed by lessee. Then we add leasehold improvements. This is your total rental income. For leasehold improvement, look whether it is outright, so recognize income as whole, or it is spread out. So the book value, you spread it out over the lease term. How about in your annuities? Only the interest portion is taxable. And lastly, partners distributive share. It depends whether that is a GPP or a business partnership. As to the partnership income, in your GPP, it is exempt. In your business partnership, it is 25% taxable. Now, as to your share of partner, in your GPP, it is subject to a CWT. If it is less than or equal to 720,000, 10%. If more than 720,000, 15%. While in your business partnership, it is subject to final tax of 10%. Now, as to whether included in gross income, in GPP, you will include it in gross income. The share in your business partnership is not included in your gross income. Okay? So that's it for your other items of gross income.